Hello everyone, good evening everyone. I hope you all are fine and doing well. Also, I am hoping that I am audible. My screen is visible. Everything is okay from my side. So, let's start the session. Module B and Module C we are going to cover today. Module B is one of the important one, right? That is belongs to risk management, where we will learn about all the risk regulations, uh, about the trinities, what is risk, what are the different types of risk, how to handle this risk, what are Basel norms and capital charge. A lot of things are there in Basel in this module B, risk management. So let's start with the class. If you have any type of issue, you can tell me in the comment section. So just starting and let's complete module B first. Okay. So starting with the definition of risk. Risk means obviously uncertainty that cause a bad outcome, right? Whenever we plan something, we expect a certain result. But due to uncertainties, the actual result may be different. So if the difference is unfavorable, we call it risk. When the difference are unfavorable, we call it risk. Example, someone has an interview and need to reach on time. To reach on time, that person will get ready on time, find a vehicle, travel to the interview place. All the steps have uncertainties. If all things goes well, that person will reach on time. If something goes wrong, that person will reach late. So the possibility of this reaching late because of uncertainties is called risk, right? Is called risk. So, in short, we can say that what is the meaning, what is the actual definition of the risk? That is uncertainty that always results in negative outcome, right? Risk means uncertainty that always results in negative outcome or outcome that is expected than worst. That is called risk, right? That is called risk. So, what is the financial risk? Financial risk means uncertainty in the profits. When the word is there, financial, that means they is related, that word is related to the money. So, uncertainty in the profit. Loss are when a business earns profit. When a business earns profit, obviously, when the cash inflow is greater than the cash outflow, that is the condition of profit, right? That is the condition of profit. And obviously, when cash outflows is more than cash inflows, so that is called loss. So, if cash inflow or cash outflow changes unexpectedly, the profit or loss will also change. This creates the financial risk. That situation creates the financial risk. This is the financial risk definition. Then, how cash inflow can be uncertain? Like, how can we say that money is coming that can be uncertain? Suppose a fruit seller earns money by just selling the mangoes. If sales or sales pricing changes, so inflow changes. One day he may sell many mangoes at a high price. Another day, he may sell fewer mangoes at a low price. There is uncertainty in the sales and price that creates the uncertainty in the cash inflow. That creates uncertainty in the cash inflow. That's why we can say that does not mean every time cash inflow can be uncertain, right? So coming money, but with full profit is important in the businesses. Now we have here how cash outflow can be uncertain. Cash outflow includes purchase price of goods, transport cost, administrative cost. Obviously, these costs are changes every day. If price purchase price increases, right? If the purchase prices increases or transport cost become high, so cash outflow increases. That leads to the financial risk, right? So what is the impact of uncertainty on net cash flow? Impact of uncertainty on the net cash flow. Net cash flow means whatever the difference between cash inflow and cash outflow. If these both are changing, the profit also keep changing. This type of variability obviously can be favorable or unfavorable. Why favorable? Because sales is higher than the expected, right? And expenses are lower than the expected. So that leads to the higher profit. If sales lower than expected and higher sales expenses are higher than expected, that leads to lower profit or loss. So that is the impact of uncertainty on the net cash flows, right? Okay. Now this next thing is here that we can say what is the difference between high risk versus high risk versus low risk business. High risk versus low risk business. See, we say that what is high risk business? What is the meaning of high risk business? When the variations are there, when the variations are there in the profit, and that variations are very high. So the business is called high risk. Example, trading in the shares and price here changes very quickly. So you may earn a very high profit or suffers a very high loss. And what is the meaning of low risk business? Low risk business when the profit remains almost stable, then the business is obviously low risk. Low risk means low chance of big profit and low chance of big loss. Low chance of big profit and low chance of big loss, right? That is the low risk business. Is that clear? High risk business versus low risk business. Then what is zero risk and risk free investment? Obviously, those investment that gives fixed or guaranteed returns. Fixed or guaranteed returns. There is no uncertainty in the cash flow. Suppose if a retired person invests their money in RBI bond for 5 years, he receives a fixed interest every 6 months. He receives his full principal amount at the maturity. There is no uncertainty in the payment. So that type of investment is risk free because there is no variations in the cash flow. But the return from risk free investment is usually lower than other market opportunities. But the return from the risk-free investments is lower here than the market opportunities. Right? That is, we can say zero risk or risk-free investment. Generally, government securities are considered to be most of the secured securities because they have zero risk available. So, If I summarize this thing, we say that risk means uncertainty that may lead to the bad outcome. Financial risk means uncertainty in profit or loss. Uncertainty in cash inflow and outflow creates financial risk. High risk give high chance of big profit or big loss. Low risk give stable but smaller profit. And zero risk means guaranteed and fixed return with no uncertainty. Right? That is basically the zero risk. Now, what are the linkages among risk, capital, and return? First, let's see the link between this risk and the capital. See, every business face the possibility of loss. This is possible for every business that they will face loss. So capital is required to absorb that loss. So even if the maximum possible loss occurs, the business does not close down. Their explanation is of this. If a business with high risk has high fluctuations in the profit, so losses may be very high. So it need more capital to survive the losses. But if a business with the low risk has steady profits and small losses, so it needs less capital. So loss high means high capital needed. Loss is low, so capital is also needed less. So in short, when there is low risk, low capital requirement. When there is high risk, high capital requirement. Right? That is the link between the risk and capital. Direct relationship. You can say this is the direct relationship. Now, next thing is here link between risk, return, and capital. Risk, return, and capital. See, we can say that higher risk investment must give higher return. Higher risk investments, because a risk or investments are connected with each other. So, if investment is high, so it is possible that their return are also high. That's why people choose them to earning the profit. So if you invest in two options, both need the same amount of money, both give the same total return over the 5 years. So investment one gives same cash flow every year. Investment two gives different cash flow every year, including a loss in 1 year, even though total return is also the same. So you will naturally prefer the investment one because it has a stable and predictable income. And investment two is riskier. To make it equally attractive, it must offer the higher return. So risk is there in every business, but as a management, everyone have to understand this relation. Then what is risk premium? Extra return that is required for taking additional risk. If someone is taking additional risk and if any profit is there for that additional risk, that is called the premium. If investment 2 pays 2% more than the investment 1, that extra 2% is the risk premium, right? That extra 2% is the risk premium. Got it? That what is the meaning of what is the linkages between this? Now, risk adjusted return. Two investment that may give the same return, but their risk may be different. So comparing only the return is very bad. We have to subtract what is the effect of risk, how to compare them. Return after adjusting for risk is called return after the adjustment. That is called risk adjusted return on capital. It is generally used by the investors to judge where to invest. It is used by the banks and companies to design the business strategy. Higher risk adjusted return means better use of capital. Higher risk adjusted return means there is better use of capital. So higher risk, higher capital, higher expected return. If lower risk is there, so lower capital and lower expected return is there. So there is a core linkage between risk, return, and capital. Clear? Three trinities of the risk management. Usually the question will be there from this one. Now we have here one thing, that is why everyone is saying that risk needs to be managed. Why? Why this risk to be managed? See, if any business that faces heavy losses due to uncertainties, due to the uncertainties, so these losses may become so large that the entire capital gets wiped out. And this thing leads to the bankruptcy. And managing risk ensures losses should be remain within a capital. Business continues without interruption. The companies know how much capital is needed, and pricing of product here remains correct and fair. So we can say that in that case, if loss is overestimated, price become very high. Business is lost. If loss is underestimated, price become very low, profit reduces, RAROC falls. So risk management protects the organization from both of the extremes, right? That's why risk management is one of the most important thing to manage the like problems in the business. Then we have some thing about the basic risk management framework. Whenever company designs its risk management system, they have to consider that risk management always start from the top, means board of directors. That means basically top management is completely responsible for setting the risk policy, fixing the risk limit, ensuring the balance between risk and return, make sure that capital is available to support the risk, and risk culture flows from top to the bottom. Risk culture flows from top to the bottom, right? So top management is very important. Then we have here risk must be identified and measured. In any risk management process, the first step is identification. So before managing risk, we must have to identify the type of risk, measure how the big it is, decide whether to accept it or reduce it. Only then can proper action be taken to reduce and control that risk, right? And third, risk management requires special skills, obviously, because risk management is a specialized activity. It focuses on controlling the risk. It must remain independent from business decisions. It requires technical knowledge and analysis. So organization create a separate risk management department. That's why there is a separate risk management department, right? So what are the components of risk management framework? First one, we have organization of risk management. And in the organization, first we have board of directors. Board of directors who are responsible to hold overall up responsibility. They set the policy, set the limits, they set the procedures. They approve the system for reporting and as well as audit. Then we have here the risk management committee. What is the work of risk management committee? This committee is under the board. In this, they set the guidelines, they ensure that policies are followed, they ensure that the risk management team is well staffed. And then committee of committee of senior executives. In this framework, we also include committee of the senior executives that implements the policy consistently, plans the business strategy to analyze and to check the risk guidelines. And then there is risk management support group. Risk management support group. Basically, it analyzes the risk, it monitors the risk level, it report the risk, that is trends to the senior management, right? Reports the risk trends to the senior management. So that is the that we include in the organization of risk management. So let's see the risk identification. What is risk identification? We know that in the risk identification, suppose if I give you the example of this, every time you have listened about the risk identification. So let's understand this with the help of example. If a branch is there that gives a loan of 1 crore for 5 years at 1% above the bank's prime lending rate. So it funds the loan using a 3-year fixed deposit at the 6%. So what type of risk will appear here? Obviously, liquidity risk or the funding risk. What is it? Because deposit here matures in 3 years. Loan will be repaid only 50% by then. So bank have to arrange the new funds to continue this loan. Then here basis risk is there because loan interest is linked to the bank prime lending rate. Here deposit interest is fixed. If the lending rate is false, interest receives reduces and interest paid remains the same. Then also here we see gap or mismatch risk. After the deposit matures, the new interest rate may be higher or lower than the 6% that creates the mismatch. And also here the risk of reinvestment risk. What is reinvestment risk? Basically, as the customer repays the loan, right? Bank must reinvest the money and the new rate may be lower than the existing loan rate. And then we have last here embedded option risk. Why? Because customers may repay the loan early, depositors may withdraw the money early, that both will create the additional risk. So you can see just in a single situation, there are lots of risk available, right? So other risks are also there, transaction level and at the portfolio level. And combination of these all risks determine the capital requirement. So that's why Basel 2 pillar 1 is say that it is necessary to maintain a minimum capital requirement, which is just important for the banks to survive in the loss situations, right? So that's why this is the risk identification. Now, what are the quantitative measures of risk? Risk management depends heavily on the numbers. Quantitative, which can be like countable. So this risk management heavily depends on the number. Both banks and financial institutions measure the risk using this quantitative tool. These tools try to find how much the bank earning is, market value is, and the losses is. That may change because of uncertain events. So there are three main quantitative measures, which is
Now audible? I hope now audible. Kindly confirm, Shobha ma'am, that I am audible now. I hope that audible. So now we are on sensitivity. Thank you. So basically, what I told you about the sensitivity, that is basically how much a target variable changes when a single market factor changes only by the one unit. That is the sensitivity. Then next we have here, what are the drawbacks of this sensitivity analysis? It consider only one market parameter at a time, but in real life many parameters change together. It considers only one parameter, that is the limitation of this, and it depends on the current market condition. So results keep changing as the market changes, right? So results keep changes as the market changes. So that is clear. So now let's move to the next one. We have volatility. So what is the meaning of this volatility? It tells how stable or unstable a variable is. It tells how stable or unstable a variable is. It measures how much the value moves around its average. Right? So, volatility is basically the standard deviation of past values of that variable. Right? So, volatility is basically the standard deviation of past values of that variable. We can see that volatility is basically answers the question that how much does this stock or interest rate jump up and down from the normal level. High volatility means higher uncertainty, right? So that is the basically volatility means. And volatility capture upside movement, downside movement, but in risk management we care mainly about the downside. Then we have here this volatility can be calculated even the data does not follow a normal distribution. We need a time series, which means a period and a frequency. So what is the formula of the volatility? Daily volatility multiplied by the square root of number of days, right? And we can convert volatility from daily to weekly or monthly using this formula, simple by this formula. Then what is downside potential? It tells how much loss can occur. How much a loss can occur. It ignores the profit and focuses on the adverse movement like value at risk. It answers the question, what is the worst loss that can reasonably happen and how likely it is. Potential loss, how big the loss can be, and probability of occurrence, how likely is to happen. So estimating the potential loss is very easy. Estimating the probability is difficult because it needs the assumption. In probability we need the prediction assumptions about the future behavior. So downside potential is also like focusing on telling that how much loss will be there in the adverse situations. This is the downside potential. So we can calculate the worst possible loss, but its probability is very small. Downside potential is most useful when it combines sensitivity, when it combines volatility, and when it focus on the adverse outcome. So banks and regulator rely heavily on this measure. Then we have the risk pricing. First one, bank transactions carry two types of burden: capital requirement, probability of loss. Both must be included in pricing. But what is the meaning of risk pricing? See, risk pricing, we can say that a type of concept or a type of thing we can say in which there is the practice of setting the prices for the product or the services that is based on the perceived risk involved. So risk pricing generally carry two types of burden, which is capital requirement and second one is probability of loss. What are the cost elements in the transaction pricing? See, pricing must include what is the cost of fund, like whatever the money used in that fluctuation, long term fund cost different from the short term funds. Their operating expenses also include loss probabilities, like what is the expected loss which is based on the historic experience, and cost of maintaining the required capital. So, return on net worth is expected by a bank, that is also included. So, that all thing ensures that bank never underprice the risk or never overprice any transaction. Then we can say here capital requirement and its cost. See, bank have to hold capital as per the rules, and this capital has a cost because here shareholders, they expect the dividends. Bank have to generate internal capital for the growth. So each transaction must earn enough to cover cost of capital, expected profits, or pricing that must include this cost, right? So what is the probability of loss? See, every risk has a chance of loss, we know that. This must be included in the pricing. Suppose if a bank has 100 credit accounts, so they are level 2 risk, because past data shows average loss and level 2 account is 10%. So 10% must be included as the risk pricing premium in the pricing. This ensures that losses are covered by income from only the similar accounts. Clear? So why we need capital and what is bank probability of loss, this is the thing. And next thing is there, what happen when the pricing, why the pricing is done at the transaction level? Simple, because we know that each loan or each investment that carries its own risk. Different type of borrowers, different type of maturities, and the products, they have different risk levels. So risk can be measured and risk can be priced for each transaction separately. That's why pricing is done at the transaction level. Clear this thing? Now we have how to monitor the risk and control the risk. Bank wants to increase their earning, but only by taking the risk that match the amount of capital they have. This idea is called risk adjusted return on capital and also known as RAROC. Just because to earn the profit, that idea is called risk adjusted return on capital and RAROC. So risk management cannot work separately, it must work together with business decisions. Bank have to take decision that balance both risk as well as return and considers whatever the capital available. Right? So that is the thing here. Right? Now the thing is that, like, we can say there, how the banks manage risk. Bank set up the things. First they set up proper organized structure, then they set complete system to measure the risk, then they set the risk policies and also the guidelines and the parameters. But is setting a structure is enough? No, because just creating risk policies is not enough. Bank have to make sure that these policies are actually working in real life. This is where feedback becomes important. So bank have to check whether the actual performance matches their planned performance. If there is too much difference between what was planned and what actually happened, then it must be corrected quickly. To keep risk at an acceptable level, bank need the following. Number 1, a strong management information system. Number 2, clearing procedures and strong controls. Number 3, a separate risk management department. Number 4, a periodic review. Bank have to regularly review their risk policies, their exposures, their systems to ensure everything is working properly. That's why feedback is important. Then, uh, what is the role of board of directors? See, board has the responsibility to check, to assess all the types of risk, to connect with the bank capital levels, and the bank is following the internal policies. That's why board risk management committee is set up, which regularly checks the effectiveness of internal controls. And what is internal control structure? Internal control ensures that activities are done safely, activities are done properly. It also includes independent review by internal or external auditors. Then we have here the risk mitigation. Right? How to do the risk mitigation? How to do the risk reduction? It means reducing or eliminating the uncertainty that cause risk. Right? So basically we can say uncertainty uh, removal is very important, and risk mitigation is one of the important step in which risk is reduced by different types of measure. How to do risk mitigate in the banking? By how to do the credit risk mitigation, like credit risk where borrower is not able to pay back the bank, so in which banks can provide the loans to the borrower by with the secured loans, by taking the collateral, by guarantees, mortgages, and with the cash margin. How interest rate mitigate? With the help of interest rate swap and with the help of forward rate agreements. And then foreign exchange mitigation risk is in which we include forward contract, options, and the futures. So these tools are there that reduces the loss but also limits the business opportunities. And in this, counterparty risk is also included, where one party is not able to fulfill their part of the obligation, that is called the counterparty risk. Right? Clear? And how to reduce the counterparty risk? Just exchanges like stock exchanges, commodity exchanges, and future exchanges, they are act as central counterparties, because whenever a trade deals through an exchange, counterparty risk becomes very low. And risk mitigation through the diversification means spreading your risk across different activities, so loss from that one activities does not spoil everything. If suppose Mr. A has a single business, his cash flow over the 5 years shows a lots of up and down. Because of these variation, his business is risky. Then the risk can be measured by using the mean or the standard deviation. And suppose his standard deviation to mean is 44%. This means his income is highly unpredictable. Right? So diversification is also a good idea to just reduce the risk. Right? You can see the cash flows here of different business and their total portfolio and their mean, their standard deviation mean is also given. So basically in this you can see that different cash flows are there for every year, for every business. Their standard deviations are different, their portfolios are like addition or the standard deviations mean is given. Then what is the meaning of credit risk? In a simple word, I can explain the credit risk. Simple word, just you can just keep this thing in your mind, that credit risk means where the borrower or the counterparty will not repay the money as agreed. For bank, loan, corporate bond are the main source of credit risk, in which risk include counterparty risk, country risk. Country risk arises when a borrower or counterparty cannot pay because of restrictions in their company, in their country. Right? And then we have one important a question is there from this accrual system of accounting. What is the meaning of accrual system of accounting? Simple, it is a system in which in this accrual method, income and the expenses, these are recorded when they happen, not when the cash is actually received or paid. Means if a bank is supposed to receive interest in the March but actually gets the money in the April, so the income is still shown in the March. So bank divide their activities into three major group of risk management. First one, the banking book, the trading book, and off balance sheet exposures. Right? So what is the meaning of liquidity risk? See, we can say that about the banking book, there are some risk available in the banking book, which is liquidity risk, interest rate risk, credit or default risk. If a basically borrower do not repay the loan, so it affects the banking book. Then we have risk in the trading book, that is market risk, credit risk and operational risk. And off balance sheet exposure, also the concept, where off balance sheet items are those obligations that do not appear directly in the balance sheet because they are not actual assets or the liabilities, they are contingent in the nature. So they become real if a certain event happens, right? जैसे for example LC, undrawn credit line, forward contract, these items create a possible future obligation for the bank, right? So this we can say the example of, we can say that this is the meaning of off balance sheet exposures. Now here, that is the thing. Okay, so what is the liquidity risk, which is basically when the bank does not have enough cash to fulfill their obligation, that is the liquidity risk. What is the funding risk? When a bank has to replace money that goes unexpectedly, like customers are withdrawing their deposits in the large amount, customers do not renew their fixed deposits, and also some of the depositors close their deposit before the maturity. So because of such outflows are planned, so bank may struggle to find replacement funds, right? This is the funding risk. What is time risk? When the time risk arises when the money that the bank was expecting does not come on time. When the bank is expecting but that money is not there on time, that is called the time risk. And when the delayed inflows are there, so obviously bank faces difficulty in managing their daily cash needs. Clear? This is the time risk, and I hope that now funding risk is also clear, right? Call risk arises when the bank has to pay money for commitments that suddenly become due. Call risk arises from the sudden obligations, like sudden obligations. Then we have market risk. And what is market risk? When there are the changes in the market factors, and due to these changes, due to these movements, the loss is there for the banks, that loss is called market risk. These price movements can happen just due to interest rate investments or interest rate instruments, equities, commodities, foreign currencies. So market risk is also called price risk, and this risk is common when assets are sold before the maturity and prices may fall. So that is the concept of market risk. Clear? That what is the meaning of market risk? Operational risk is one of the dangerous risks that basically happens due to the people, processes, or some of the external events. This operational risk means when the loss caused by problems in internal process, people, system, or external events. There are two types, which we having the transaction risk. This risk arises from the failures during the transaction. And second, we have compliance risk, which arises when a bank does not follow rules, laws, regulations, or code of conduct. This can cause legal penalties, financial loss, or damage to the reputation. So, this is also called integrity risk because a bank reputation depends on honesty and as well as the fair practices. So, regulators like RBI, they are paying high attention to compliance their culture. That is the compliance risk, right? That is the compliance risk. Strategic risk, when there is not enough strategy available, or the strategy whatever is made for the business benefit, that will create problems, that is called the strategic risk. Then we have reputational risk. When there is any goodwill damage, any reputation damage, that will create a panic situation into the customers. They will go and they will withdraw their money and they will lose their trust. Mark to market, it is an accounting method where the value of an asset is changed to just match the current market price, where the value of asset is changed to match the current market price. This means the asset is valued at the price it would fetch it was sold in the market today. So suppose if a bond is bought for 10 lakh, now only worth of 9 lakh. So under mark to market, the value in the books will be shown as 9 lakh rupees. Right? So whatever the situation in the market, mark to market changes their colors according to the market situation. That is the concept of mark to market. Then banking book, which contains all the normal banking item like loan, deposits and borrowings. That is the banking book, which is related to the regular commercial and retail banking operation. That includes all the banking items. And what are the feature of asset and liabilities in the banking book? They are capped until maturity. They follow the accrual method of accounting. They are not valued using mark to market. They require capital for credit risk, not the market risk. And in trading book, we contain all the assets that can be actively traded in the market. All those assets that can be actively traded in the market. So assets are not capped until the maturity. Bank buys the government securities and sell those securities in 1 month. Here mark to market is applied. And what should be included in the trading book? Government securities, corporate bonds, share, foreign currency, commodities, derivatives which are used for hedging or trading or hedging the trading exposure. Right? I hope that you are sure, you are clear with the off balance sheet items. What is the meaning of off balance sheet items? Off balance sheet items, you can say that those things that are not visible in the balance sheet, right? That weekends is the off balance sheet exposures, right? So this is basically about this. Now the thing is there, what are the risks associated with this? Liquidity risk, interest rate risk, market risk, credit risk, operational risk. Interest rate risk, when there are the changes in the interest rate and these changes affects the income or profit due to the market interest rate change, that is called the interest rate risk. So basically, when interest rate goes up or down, the banking earning from the loans and the cost of deposits also changes. That affects NII, which is the difference between interest earned and interest paid. And interest rate risk means when the value of asset or liabilities may change due to the interest rate movement. So if a bank may have invest money at lower interest rates in the future or borrow the money at higher interest rate, both are the losses for the bank. I checked the voice, actually the limit is there. only this limit is allowed. That's why there is no problem from the software side. I will speak loud to help you. So I hope that this is clear with the interest rate risk. Now, what are the types of interest rate risk? First one is gap or mismatch risk. Gap risk is happens when a bank assets and liabilities mature and get repriced at different times. Like, I have to purchase a single separate mic for this. I will purchase, but I wish that you will not need again the BFM reading. You will clear all your exams tomorrow. That is the only thing I need. So all the best for tomorrow, and please kindly share the questions level and your marks. I will be waiting. Even I am not going to slip, because this is the curious day that everyone is clear their exams. So that is gap or mismatch risk, with basically when the bank assets and the liabilities, they are mature and get repriced at different time. Already this PPT is there, you can go and read this. I have already uploaded. Basis and keep these risk we already discussed yesterday. Forex risk, when the bank deals in forex currencies and their value changes. And market liquidity risk, when basically bank is not able to sell their assets in the market due to few buyers are there or not getting the enough price. That is the market liquidity risk, right? And forex risk is there when there is changes in the foreign currencies. Okay, now finally we are there in the Basel 1. What is Basel 1? First global rule book. Basel 1 is the first global rule book which created to make sure that all over the world keep enough capital. Capital means the bank own money which work like the safety cushion. These rules were made by Banking Committee on Banking Supervision, a group of central banks from the major countries. That is the basically Basel 1 is, right? That is the Basel 1. Just a minute. So that is the concept of Basel 1. Now, why this Basel 1 introduced? What is the issue that this Basel 1 is introduced? Like why we have to introduce this Basel 1? So simple one is thing is there in the 1988. This Basel committee published the Basel Capital Accord, later called Basel 1. And these rules become law in the G10 countries by the year 1992. Most of the countries in the world later adopted these rules, even they were not the part of G10, sorry. So Basel 1 introduced one of the biggest idea, that every bank have to maintain minimum capital to 8% of its risk weight asset. Risk weight asset means assets are multiplied by the level of the risk they are carrying. And in India, RBI is saying that Indian banks have to maintain at least 9% of the capital, 9% of the risk weight assets, like minimum requirements is 9%. So during the 1980s, many countries removed strict banking control. Bank then started competing more. This competition increased the risk of losing money. At the same time, the Latin American debt crisis happened. Many countries in the Latin America could not repay the loans and taken from the big international banks. This made the Basel Committee worried because large banks had very low capital. Low capital means they had very little of their own money to absorb the losses. So committee felt that bank must be forced to keep a minimum amount of capital. The capital should be linked to the riskiness of bank loans. Right? So now that's why the Basel one is introduced. That is the only reason we introduced, like banks introduced, committee introduced Basel 1. Okay. Now however the bank assets are classified. Assets were divided into 5 groups based on how risky they were. Each group was given a risk weight. High risk weight means bank has to keep more capital. Right? If high risk weight is there, that means more capital is required. So, simple example, imagine a bank is having 100 crore in government securities, 100 crore in home loans, and 100 crore in personal loans. Now, risk weight asset calculation here, 100 crore multiply by 0% because government securities have 0% of interest rate risk weight asset. Then home loans having 50%, that means 50% of 100 crore, 50 crore. And in personal loan there are 100%, which means 100 crore. So total risk weight asset is there 0, 50 plus 100, that is 150. So bank must keep capital of at least 8% of this 150%, which is equals to 12 crore. That is the minimum money bank have to keep set aside to like for the bad situations. Right? Clear this thing? Okay. Now the thing is there, does the Basel Committee have the legal power? So the answer is no. Basel Committee cannot enforce the cannot enforce it rules. It only give guidelines and the best practices. Each country regulator like the RBI, they decides how to apply them, but the main objective of the committee are no foreign bank should escape the supervision and every bank should be supervised properly no matter where it is operate. Right? No matter where it is operate. So that is the important thing. Does the Basel Committee have the legal power? No. Then in the 1996 the amendment is there. In the 1996 the amendment is there that tells about that Basel 1 is considering only the credit risk. Right? Banks also face the market risk. So in 1996 Basel Committee added the rules for market risk. And what are the key points in the amendment? One bank were allowed to use their own in the house model to measure the market risk, And second, bank use internal models. They had to calculate value at risk every day, and value at risk had to be based on 99 percentile, one tail distribution, 10-day holding period, and at least 1 year of historical data. Right? So, capital, whatever required for market risk, should be higher of yesterday's value at risk, or 3 times the average value at risk of the past 60 business days. Banks, they are allowed, they can issue short term subordinate debt, that is called 3 tier capital, to meet the market risk requirement, and a standardized method was also given for banks that did not use the internal model. Banks had to create a separate trading book and mark the all positions to market daily. These rules applied to both banks and the securities firm. Right? So, basically, why the Basel 1 removed by the Basel 2? See, Basel 1 linked the capital with risk, but it had several problems. First one, credit risk measurement was not sensitive enough. That is basically follows the rule of one size fits all. It gave the same risk weight to all the corporate loans. If suppose a loan is having highly safe company with a triple A rating, and a loan is with the risky company having B rating, these both loans are given the same rating, same risk weight of 100%. That creates the problem. That is the unfair thing. And also, it encouraged the wrong financial decisions, because capital requirement was the same for all the corporate loans. Bank preferred to give loans to the riskier companies because risky loans give higher return, and this was not good for the financial stability. So that's why there is the problem with the this Basel 1, and that is the situation. Basel 1 removed. Right? Now, in Basel 2, what is new? In Basel 2, basically, the Basel committee decided to revise the old rules. Their main goals are, they have to make the international banking system safer and also the more stable. They ensure that fair competition is there among the banks, and it also encourages better risk management. Right? So that's why Basel 2 is needed. Okay. Now, it also ignored modern risk reducing tool. Which one? Basel 2. Sorry, Basel 1. And it also ignored the operational risk. So that creates the problem with the Basel 1. And that's why Basel 2 introduced in 1999. The Basel Committee proposed our new capital adequacy framework, which later known as Basel 2. After almost 6 years of discussion and the improvement, the final version was published in 2004 of June. A combined and updated version includes trading book rules that was published in June 2006, and different countries adopted Basel 2 at the different times. Right? And there are 3 pillars of the Basel 2. Basel 2 is completely made on the 3 pillars. What are these 3 pillars? Pillar 1, minimum capital requirement. Pillar 2 is supervisory review process. And And pillar 3 is market discipline. Like market disclosures are important to just tell the customers that or stakeholders that what is the health of the bank, right? So before Basel II, Indian banks had to maintain a capital ratio of 8% up to 31st of March 1991. But after that, RBI increased the limit of minimum capital, that 9% is required, and this is still followed in the India, right? Then capital for the credit risk, bank have to choose one of the approach here. First approach is standardized approach, where bank use external credit rating from the rating agencies, and risk weight depend on the rating of the borrower. Internal rating based foundation approach, where bank use their own internal model to estimate probability of default, but with some of the restrictions. And internal rating based advanced approach, where bank have to use advanced internal models. They have to estimate probability of default, loss given default, and exposure at default, and the maturity. These are the three methods for credit risk. Then for three methods are there for the market risk: standardized approach maturity method, standardized approach duration method, internal model method using value at risk. And for operational risk, BIA basic indicator approach, which is used in India, where capital is based on the percentage of bank gross income. Standardized approach, income from different business line is multiplied by risk factors. And advanced measurement approach, where bank develops its own model for operational risk. These are the different approaches for the capital calculation for different types of risk, right? Is that clear? Okay, so they can ask the question about this. But now, pillar 2, supervisory review process, in which it gives the powers to the regulators such as RBI. It evaluates how the bank assess its own risk. It checks whether the bank internal system for calculating needed capital are sound. It ensures the banks always maintain minimum capital. If the capital falls below the requirement, the regulators can take prompt corrective action. And it also allow higher capital requirement for bank whose risk management is weak. Right? So just a minute. So that is clear, this thing about the pillar 2. And the third pillar is discipline, market discipline. That is all about the disclosures and the transparency, where bank must disclose key information to the public, give core disclosures and supplementary details, publish this information at least twice a year. So the idea is that if bank disclose more information, the market will punish unsafe behavior by demanding higher interest or withdrawing the investment. Right? Now Basel 2 is done. Now the Basel 3rd. Like how we the Basel third. So there is complete step by step story. uh, Basically, let me tell you all the steps first, how we shifted to Basel 3. So there is the first step towards the Basel 3 on September 2008, after Lehman Brothers collapse. Then Basel Committee issued the principles for sound liquidity risk management. Now, these principles told the banks how to manage liquidity properly. Right? Then, on July 2009, it is strengthening the Basel 2. The committee issued new rules that especially for the trading book exposures, and these type of changes were required because the crisis exposed how risky these areas are. And then final standards published after 2010 in G20 approval, that G20 summit in the Seoul, leaders approved the Basel 3 reforms. Later, the Basel Committee officially released the new rules in 2010, and final standards were published in the documents that is titled Basel 3 International Framework for Liquidity Risk Measurement. Right? So basically, why BCBS moved towards Basel 3? Because Basel 2 was not enough. It shows a major weaknesses after Lehman Brothers collapsation. And what is the main problem in the banks before the crisis? Too much leverage. Banks are giving debt too much without any tension. No liquidity is there, and there is poor governance and weak risk management is there. So that's why Basel 3 is required. And what new things did Basel 3 introduce? Basel 3 revised and strengthened all three pillars of Basel 2. It also added several new features. And in this, first is the capital conversion buffer, which is an extra layer of common equity that banks have to keep. So if the bank capital falls below this buffer, it cannot pay high dividend or bonuses. If the capital falls this buffer, this ensures that bank rebuilt its capitals during the tough time. That is the capital conversion buffer. Right? Then second is counter cyclical capital buffer. This buffer protects the banking system during the period of excess credit growth. If the economy is booming, banks are lending too much, the regulators can activate this buffer. Later, when the economy slows, banks are protected from sudden losses. Then we have leverage ratio. This is a simple measure that compares a bank total asset to its capital. It is very simple measure where bank total assets are compared to its capital. It does not depend on risk weight. It ensures bank cannot use excessive debt to grow too big. So even if a bank show low risk on paper, the leverage ratio prevent it from becoming over leveraged. Then liquidity coverage ratio, bank have to hold highly quality liquid asset to survive a 30-day severe stress situation. Then net stable funding ratio, this is a long term measure. It ensures bank use stable source of fund for long term assets. And then we have the rule for the systemically important banks. Basically, these are very large banks whose failures can damage the whole economy. So, example, State Bank of India, HDFC Bank, ICCI Bank, these banks have to keep additional capital, contingent capital, better cross border supervision. Clear? Now, the thing is there that why is Basel 3? Why? Why the Basel 3 is required? Because this Basel 3 is a set of global banking rules that are created by Basel Committee on Banking Supervision. These rules were introduced after the global financial crisis of 2008, and the main purpose is to make the banks stronger, to help them surviving the financial and economic stress, to reduce the chances of bank failures, and to stop problems in the banking sector from spreading to the real economy. Right? So if a bank has good capital and following the Basel 3 rules, even there is a recession or customers withdraw money suddenly, the bank can continue its operation safely. So Basel 3 implementation, basically in January 2012, the group of governance and head of supervision approved a program that is called Regulatory Consistency Assessment Program. It has two parts: monitoring the timely adoption, check whether each country is implementing Basel 3 on time, and also checking the consistency, ensuring that countries are following the rule correctly without having any major deviations. Right? And one more thing, why the Basel 3 rules created at the G20 meeting, which is held in Pittsburgh in 2009. World leaders decided banks should have to maintain better capital, banks should have to avoid excessive risk taking, derivatives trading should become safer, large global banks should be held responsible for the risk they take, and also to achieve these goals the Basel Committee released a full reform package in December 2010 that called Basel 3, a global regulatory framework for more resilient banks and banking system. Right? That's why the Basel 3 rules are needed. So Basel 3 rules was not applied immediately. They are phased in slowly to avoid harming the economic recovery. It strengthened definition of capital, was introduced from 2013 and completed by 2017. Capital instruments that no longer qualify under the new rules were phased out over 10 years starting from the 2013. Common equity capital and tier 1 capital increased gradually. Early, common equity capital is having only tier 1 4%, and then in 2013 common equity is 3.5%, tier 1 is 4.5%, and then in 2014 common equity become 4% and tier 1 become 5.5%. Then in 2015 common equity become 4.55 4.5% and tier 1 become 6%. So this also increased gradually. Then capital conservation buffer, this buffer of 2.5% started in 2016 and was fully effective by 2019. Right? So that is the capital conservation buffer. What is the leverage ratio? What is the leverage ratio? See, you can see the questions from the leverage ratio, as I already uh, practiced some questions in the module D of the leverage ratio. Basically, what is leverage ratio? It is, you can just say that this is a financial metric, that how much a company level of debt is having relating to the another financial metric, right? That is the leverage ratio. Then LCR, you already know that. NSFR, you know that what is NSFR. Then one thing is there, that what is the scope, like bank have to follow this Basel third now, right? But they have to follow the capital rules at the consolidated level. Like bank have to calculate capital after adding the assets and as well as the liabilities of subsidiaries, joint ventures and associates. But companies who are involved in insurance and non-financial activities, they are excluded. Second level is standalone level, where bank have to calculate capital which is based on own individual position. And also, if the bank has the branch outside India, those branches are also included in both of the calculation, right? They have to be calculated in both of the calculations, right? So under Basel 3, every bank have to maintain a certain amount of capital to protect itself from the losses. The capital is compared to the bank risk weight asset. The idea is very simple: high risk, more capital needed; low risk, low capital needed. Clear? So what are the main purpose of Basel 3? That aims that each bank strength shows their strength, and it tries to enforce better quality capital and high overall capital and better risk coverage, and also strong supervision and transparency. Basel 3 introduced, that's why, two capital buffer, capital conservation buffer and counter cyclical buffer. This protects the bank during the period of high credit growth, right? Is that clear why the Basel 3 is needed? Now RBI issued Basel 3 guidelines on 2nd of May 2012, and implementation started from April 1st 2013. Initially planned completion, then postponed to the March 2020. Due to pandemic, it is extended to April 2021. But three pillars of Basel 3 are: first, we have minimum capital requirement, in which basically we include what? The bank have to maintain minimum capital for three types of risk. First one, credit risk, market risk, and operational risk. Right? Okay. So bank have to maintain minimum capital for three types of risk: credit risk, market risk, operational risk. And what are the methods of the credit risk? Bank have to choose standardized approach, foundation internal rating based approach, advanced internal rating based approach. Then what are the methods for operational risk? These are the methods I already told you, but in India RBI is saying you have to choose standardized approach for credit risk, use basic indicator approach for the operational risk, and continue using the standardized duration approach for the market risk, right? And a bank is not technologically advanced, they have to use simple standardized approach. Pillar 2, supervisory review. Bank do internal assessment of their capital adequacy. RBI review whether our banks are taking too much risk and ask them to maintain additional capital. Then we have here pillar 3, market discipline. Disclosures are important. Bank have to disclose financial information to the public, which increase transparency, help the investor, customer, and analyst understanding the risk profile. So what are the migrations? How to migrate to the advanced approach? Bank can choose advanced approaches, but if a bank adopt advanced measurement approach for operational risk, they have to continue with the standardized approach for credit risk. Bank have to take approval from the RBI before shifting to any advanced approach, right? Then in the Basel third, there is the composition of regulatory capital. As we know that under Basel 3, every bank have to maintain a minimum amount of capital, advised through the RBI, and RBI have to check how the bank manages different types of risk, right? In which we can include the interest rate risk in the banking book. If interest rate rise, so bank loan rate do not increase, bank may earn less. In the case of liquidity risk, if many customers withdraw money at the same time, can the bank pay them? No. Concentration risk, if the bank give too much loan to just one sector like real estate, obviously it become risky. And residual risk, this is the risk which left over even after the bank has taken steps to reduce the risk, right? So that is this our liquidity, sorry, this is our the risk, residual risk. So 9% according to the RBI. In all over the India there is 8%, but in India according to the RBI the bank have to maintain 9%. They have to maintain minimum capital to risk weight asset ratio of 9%. The 9% is the minimum required capital, which excludes the additional buffer. Additional buffer, counter cyclical, and counter capital conservation buffer are not included in this. And why does the RBI check more than 9%? RBI does not blindly accept 9% from every bank. RBI checks these things: how the risk bank business is, how strong the bank risk management, whether the bank can measure and control the risk properly or not. If the bank take more risk or manages the risk poorly, RBI can order bank to maintain more than 9% under the pillar 2, right? And if RBI feels a bank is dealing with high risk sectors, does not have strong risk management, or is not accurately measuring the risk, so RBI can ask them bank to hold extra capital above the 9% requirement. This is known as the supervisory requirement under the pillar 2. And even the minimum required capital is 9%, bank are expected to keep more than the minimum. And why this is? Because market expects stronger capital, sudden loss can occur, capital buffers must be maintained. So if the minimum is 9%, a well managed may operate at 12% or more to stay safe. Right? There is no limit in maintaining like lot of amount. That can be okay, but minimum should be 9%. Is that clear? And how the bank compute Basel 3 capital ratios? First they have to identify total regulatory capital, then they have to calculate total risk weight asset, then they have to divide the capital by the risk weight asset to find the capital ratio. That tells whether the bank has enough capital to absorb losses or not. So you can see how to calculate tier 1 capital ratio. Tier 1 capital ratio with the additional capital and common equity capital, and how to calculate CRAR. These are the formulas here. Clear? Is that clear? Now here, trading liquidity risk. What is the meaning of trading liquidity risk? What is trading liquidity risk? That means the ability to buy or sell the securities freely in the market. So basically, trading liquidity means that is the ability to buy or sell the securities freely in the market without disturbing the price, attract unwanted attention from other participants, and also compromise on the credit quality. There are two types of liquidity risk: asset liquidity risk or market liquidity risk. Asset liquidity risk, it occurs when a particular security has low trading volume, and market liquidity risk is what? When the entire market faces a liquidity problem. And in a poor liquidity market, price movements can be very large. Right? And what is market risk? Market risk, when the market factors are changed. Due to these unfavorable changes, there is the loss to the bank, that is called the market risk. So you can see the example here. Mr. X has 10,000 rupees of his own money, right? He buys shares of company named ABC Limited. The share price is 100 rupees, so he buy 100 share. His total investment or his portfolio value is 10,000 rupees. Now suppose the share price falls by 5%. So the new price is 95 rupees. His new portfolio become 9,500 rupees. So obviously he lost 500 rupees. So this loss is due to the fall in the market price. That is called market risk. Right? And what happens if he borrows the money? If Mr. X is allowed to borrow 9 times his own capital, so he borrows 90,000 rupees and add his own 10,000 rupees, and total investment become 1 lakh rupees. So if the share price fall by even a small amount, his loss become much larger. So with a 5% fall, the loss become 5,000 rupees. This is the half of his own capital. And if the price falls by 10%, the entire capital can be wiped out. So borrowing increasing money market because losses also increase. Right? Um, so market risk in the banks. Banks have to deal in financial instruments such as debt securities, shares, foreign investment, commodities, derivatives which are used for the trading. And all these are kept in a section that is called trading book. Bank face market risk due to the movement in the prices, interest rate or exchange rates. That is the market risk. Liquidity risk where difficulty is there in buying or selling the securities. And credit and counterparty risk where risk that the issuer or trading partner may default. Right? Then what is the market risk for a bank? Where the risk that the value of trading portfolio may fall due to market movements during the time taken to sell the securities. The longer the time needed to sell, the higher the risk. Clear? Clear that things? What is the market risk? So market risk is also considered as one of the dangerous risk, right? Because movements can change lot of loss for the banks. So here we can say there is also a market risk management framework in which it includes risk identification, risk measurement, risk monitoring and control, risk mitigation, right? And what are the credit and counterparty risk in the market instrument? Credit risk exists even for the traded securities such as bond, debenture, commercial paper. Credit rating agencies give rating and show the level of risk. So lower rating means higher risk. Investor expects higher returns. This increases the yield and reduces the market price of the instrument. And whatever the fall in price is the part of the market risk. Right? Then settlement risk. Her state case is the best example where in any transaction, in any market transaction, one party gives money and receives the securities and the other party gives the securities and receives the money. So if any party fails to deliver, the other party suffers the loss. That is called the settlement risk. It can even lead to failure of whole market system. And in India, RTGS helps to avoid the risk in many transactions. So in government securities and foreign exchange, settlement is handled through the CCIL, which act as a central counterparty. Clear? So are you getting it? Like things are understandable? Any problem up till now? hope that everything is clear up till now. That is the concept of settlement risk, right? Now we have here what is the organizational structure of market risk management. Bank need a proper structure to manage the risk. Same, they need the board of directors, right? They need the risk management committee, which is same for everyone. They need ELCO, risk asset liability management committee. Just a second. Then ELCO basically responsible for daily management of risk and business policy. ALM support group, which monitors the risk, report risk to the ELCO, studies the effect of changes in interest rate, exchange rate, and recommend actions. Then middle office, this is very important independent unit. It handle monitoring the market risk, measuring the market risk, analyzing the market movement, and also reports to the ELCO, right? So now there is the concept of risk identification. Risk identification. See, in the risk identification, all the products and the transactions must be studied for the risk they carry. Standard products, basically they have a product program that contains procedures, limits, and control. So how to measure the risk? In this case, how to measure the risk? They use the temporary product transaction memorandum until a full product program is prepared. So bank have to ensure the screening of the risky product, proper safeguards, product wise exposure limits, and also the clear guidelines for taking the risk, right? Is that clear about the risk identification? So using the correlation measures, suppose if two instruments move in opposite direction, combining them reduces the overall risk. Simple example, you buy the stock A, you also sell the future of stock A. If stock prices goes up, you gain on stock but loss on future. If stock prices goes down, you lose on stock but gain on future. So loss in one position is balanced by gain in the other. So overall, all the volatility reduces. This is called the hedging. This is called the hedging. Is that clear? Okay. Now, credit risk, easy to understand. whenever a borrower fails or defaults in giving back the money, that is called the credit risk, right? Same, the organization structure is also same in managing the credit risk. Here, what we include in the credit risk, basically credit risk is one of the dangerous risk because it affects the bank in direct or indirect manner. It affects the bank. It only arise in the loans. Not only arise in the loans, it can arise in other banking activities as well. Why? How? Like you can say, example I can take, if the bank is issuing a guarantor or a letter of credit and customer fails to pay, so when the liability arises, the bank will have to make the payment. Similarly, in treasury operations or derivative trading, if the other party does not pay during settlement, the bank suffers a risk. So, even in the foreign transactions, if a country suddenly restricts money transfer, the bank faces the credit risk. And credit risk appear in many forms, right? Uh, then portfolio level risk, when bank looks at the credit risk for the entire loan portfolio instead of individual borrower, the risk is called portfolio risk. There are two types of risk. First type is systemic risk, which is called intrinsic risk. This is the risk that remains even when the portfolio is fully diversified across the different industries, areas, and borrowers. This risk depends on the overall economy. And second type is concentration risk. When there is too much exposure to one sector, and that sector, that group, that individual fails, that is called the concentration risk, right? Just read this one, counterparty risk. I think you know that. What is country risk, you know that. Then read this one and just allow me 2 minutes only. Okay, so sorry for this. So, here, how to measure the credit risk? Basically, measuring the credit risk is about understanding how likely a borrower is fail in repaying the loan and how much the bank could lose if that happens. So, bank can measure credit risk in two main ways. First one, first one is here, uh, credit rating and scoring. This is the way to assess the quality of the borrower. Bank try to predict whether a borrower will continue to pay on time and remain a performing account. Performing account is one where the borrower fulfill all the obligation like paying interest and principal. And estimating loan losses is where bank also try to estimate how much they might lose in the future. Expected loss, that we have in our mind that the type of loss may be occurred, and unexpected loss, the extra loss that might occur if actual losses are higher than expected, like during sudden financial crisis. So we can say managing the credit risk means handling the four things: identification, measuring, monitoring and controlling the risk, and reducing the risk using different techniques such as collateral and as well as the guarantees, right? And why the credit rating is important? Because it helps in telling the credit worthiness of a borrower. It is not just about the profitability. A company may earn high profit but still have unstable cash flow. So, a borrower with stable cash flow, even the profits are lower, may be safer. And what is the purpose of credit rating? Is to estimate whether a borrower will meet obligations in the future or not. So, ratings are based on several factors like financial strength, management quality, the industry they operate in, and the business environment. No model can perfectly predict the future, but banks rely on the credit rating and they are based on the historical behavior of the similar borrowers, right? um, so here, what are the approaches for the credit rating? First one is simple. uh, we have the credit rating model which classify the borrowers according to their risk. They, this thing is consider stability, and more stable revenue means lower risk of default. And then rating migration tracking, which means tracking how a borrower rating changes over the time. So suppose XYZ Limited is rated B plus on 31st March of 2024, and on 31st March 2025 the rating changes to B based on updated financials. This movement is called rating migration. So observing migration for a single account is not a useful, but we track a large number of borrower, we can estimate default probabilities. And why this credit rating is important? Because credit rating is important to just know about the financial health of the borrower. That helps the banks to get protection from the credit risk, right? And also credit rating is about predicting the ability of a borrower, that that borrower is able to meet the future obligations, not the profitability. Expected and unexpected loss help the banks quantify the risk financially. And the next thing is rating migration help the banks in monitoring changes in credit quality over the time. And pricing of loan depends on the borrower rating to ensure that cost of default is covered, right? Then there are different types of credit risk models. First one, we have Altman G score. This model predicts the chance of company going bankrupt within a year. It uses 5 financial ratios based on the company accounting information, and the equity value to measure the company's financial health. JP Morgan credit metrics, this model focuses on the changes in the value of a loan due to changes in the borrower's credit rating. It tracks the probability that the borrower may move from one rating category to another. Right? Credit sues credit risk. This model uses statistical and actuarial calculations to estimate expected defaults and unexpected losses. And it does not depend on market prices but purely on historical default probabilities. These are the three methods which are useful. So lending money is the uh, primary way that banks take the risk, and credit risk forms the largest part of the bank total risk. Because lending is widespread and risky, bank need strong system to control and monitor the credit risk, and this is done both at the level of individual loan and at the level of entire loan portfolio. Clear? Okay. So then we have here credit approving authority. Bank follows a structured delegation of power for loan approval. For high value loan, approval is done by a committee on approval grid consisting of multiple officers. One officer is from the credit risk management department, which is always the part of committee to provide independent risk perspective. So if a corporate loan of 50 crore needs the approval, the loan proposal goes to a committee of 4 officers. One officer is from the CRMD and focuses only on risk, not the profit. This ensures decisions are balanced between business targets and risk management. Then prudential limits are the limits that helps the bank in managing the credit risk by limiting the exposure. That can include financial limits like the current ratio, debt to equity ratio, return on capital, debt service coverage. And exposure limits to the single borrower or the group of borrower, limits on exposure to a particular industry or the sector, and limits are also there on the large exposure and loan maturity profiles. Right? Then we have here transaction based rating. So let's learn about it. At the individual loan level, bank uses the following processes. First is credit appraisal process, because before giving a loan, bank analyzes the borrower's financial, also the business performances, industries, and the repayment capacity. And this thing ensures only the credit worthy borrowers are approved. Right? Then in the case of risk analysis, bank always analyzes the risk related to the borrower's business, financial position, and the market conditions. And credit audit and loan review is also important, where periodic checks ensure that loans are performing as expected or any deviation from normal behavior are reported and corrective measures are suggested. And we have then monitoring process, which basically continuous monitoring ensures that the bank can detect any type of deterioration in the borrower quality and act early to mitigate the losses. So bank formalize these processes through policy documented in the bank loan policy, and it is should be approved by the board of directors. Then we have risk based pricing. Loan pricing should reflect the borrower's risk. High risk borrower pay high interest to compensate the bank for potential losses, while low risk borrowers pay less risk. Right? And portfolio level risk control, bank look at the overall exposure and concentration. Portfolio risk management includes identify the weak areas in the portfolio, setting the quantitative ceilings for loans in each rating category, monitoring the exposure dis- distribution across the industry, sector, and rating categories, and adjust the portfolio composition to reduce the concentration risk. So, if a bank finds that loans to the real estate sector are performing poorly, it may tighten the credit standards for the real estate sector. And new real estate loans that reduce the exposure in that sector. Right? Then Altman G score is the method which is used to predict the likelihood of a company going bankrupt within the next 12 months. It was originally developed for manufacturing the companies in the United States. And what is the idea behind this model? If the company financial health can be measured using a combination of five accounting ratios, and these ratios reflect the liquidity, profitability, leverage, and efficiency. So Altman combined these ratios into a single zone called G score, right? Which indicates the default risk of the company. So this is the formula of the G score. You can see where x1 is liquidity, net working capital divided by total asset, x2 retained earning, x3 profitability, x4 leverage, x5 asset turnover divided by efficiency. Right? Then we have here one thing, that is rating standards and benchmarks. What is it? See, bank update their borrower credit ratings periodically, usually quarterly or at least half yearly. This helps in estimating expected losses accurately and tracking the rating migration, that how the borrower move between the ratings. It improves the accuracy of default estimates. If I give you the example on this, let me give you the example. Suppose if 100 A rated borrowers are there, right, and one upgraded to the A plus plus. 79 remain A only. 10 downgraded to B plus and 2 default. So this helps the bank to calculate the probability of default for A-rated borrower and adjusting the loan pricing and credit limits accordingly. That is the concept of rating uh, here, standards and the benchmarks. Clear? So we can say that at last simply that credit risk models like Altman G score, credit metric, credit risk plus help the banks in estimating the potential loss. Transaction level control ensures individuals loan are properly assessed, approved and monitored. Prudential limit, rating updates and risk based pricing manage the risk at both the loan and portfolio level, and portfolio level monitoring ensures the overall loan book is balanced, diversified and resilient to the economic changes. Clear? And apart from this, in the ratio, here we can say that if G score is less than 1.81, the company is considered as high risk. If more than 1.81, the company is considered in low risk and it is financially stable and not able to like default. So the higher the G score, the lower the risk of default. It combines liquidity, it combines profitability, leverage, efficiency into one number. And G score is a forecasting tool, it is not a guarantee. It is based on historical accounting data and the probabilities. Now we are moving to the dangerous risk, that is the operational risk. So let's move to the operational risk. It is the risk you have to keep in mind that happens due to process, people and the error, external error. External error means if someone employer do the fraud, operational risk is there. And suppose if any misunderstanding or mistake by the employer, operational risk. System fail or like technology fail, process error. And external event which are not in the control of banks, like COVID-19 situation. So this is considered as one of the dangerous risk. Any problem related to the process, people or external event that disrupt the daily operations of the bank, that is considered as the operational risk, right? So also here the this our Basel committee, which is an international body that sets the standards, defines the operational risk, the risk of loss that is resulting from inadequate or failed internal process, people and system, or from external event. So operational risk is recognized as a critical risk under the Basel II rules for the banks. So banks are required to maintain capital, especially to cover the operational risk, show how seriously it is taken. So operational risks are classified. Uh, this can be happen, and this is the part of every organization. So it is everywhere. However, it can impact. It impact. Its impact can vary, and basically some risk may happen frequently, but causes the little damage, while other may happen rarely but cause the huge losses. So Basel second provides here some ways to classify the operational risk. So let's learn what are these ways. You can see First one is cause based classification, where the classification focuses on what causes the risk: people related causes, process related causes. Process related causes control based risk due to the uh, proper poor internal control, such as not properly separating duties of lack of supervision, technologically related causes, and the external causes. Then effect based classification, that focuses on impact or effect of operational risk on the legal liability, regulatory penalties, loss or damage to the asset, and loss of recourse, losing the opportunities to recover the money. Event based classification: internal fraud, fraud by the employer, fraud by the theft by the employer; external fraud, hackers, cyber attackers; employment practices and workplace safety, where losses from violating the labor laws, health and safety regulation, and discrimination claims. Then client product and business practices: losses from failing to meet obligations, damages to the public asset, there is any type of business disruption, and executive delivery and process management, where loss are there in the transaction processing or managing the operation. Right, so these are the classifications. Right, now we can say that operational risk is unavoidable, but understanding it help the organizations which manage and reduce the losses. It can come from people, process, technology, or external event. By classifying it according to the cause, effect, or event, organizations can identify the weak point, put safeguards in the place. So if a small error is there in the process, like entering wrong data in a transaction, or a big external event like a flood, that can lead to significant loss if operational risk is not managed properly. So are you getting it, like everything is understandable? I hope that things are understandable. I try to make the notes easy, language easy, so it will be helpful. So now, huh? So the main thing is there, that this operational risk management, this is about identifying, measuring, and controlling the risk that arises from the way an organization operates. These risks are come from people, process, technology, or external event. And this BCBS issued the guidelines in 2003 for the banks and the supervisors on how to manage operational risk. These were later updated in 2011 under principles for the sound management of operational risk and the role of supervision. You can see the principle here. First principle is leadership by board of directors. Means the board of directors should lead in creating a strong, strict management culture, where a bank encourages all the employees to report error or mistake without fear of punishment, and create a culture of transparency. So by chance human errors are there, so there is a policy, there is a principle for the employers. They have to tell that okay, we are human, we have done a mistake. Then integrated risk management framework. Bank should have a framework for managing the operational risk. Banks can't ignore the risk, this risk, right? So a small regional bank, they may have a simpler framework compared to a multinational bank within complex operations. Thank you, sir. Then we have third principle, everything must be uh, understandable, everything must be like checked by the board of directors. There should be risk appetite. What is risk appetite? A willingness of a bank, that a bank can take that much of risk. Role of senior management checks that every policy is implemented or not, or they have to report to the board of directors, right? Then we have identification and assessment. Identification is one of the major step where all the risks are identified. Then according to the principle 8, operational risk should be regularly monitored. Bank have to use strong internal control and policies to reduce the operational risk. And business resiliency and continuity, bank should have plans to continue operation during the disasters or the disruptions. And public disclosure, bank should provide enough information to stakeholders how the operational risk is managed. So these things are important. Then operational risk, how to quantify it? We have three methods. First one, which is one of the popular method, basic indicator approach, in which we have to calculate the gross income first, net interest income plus net interest income. And here years with which are having negative or zero income, that are ignored. Then we have to multiply it by the fixed percentage of their average gross income, that is 15%. Standardized approach, where bank divide their activities into 8 business lines, and each business lines have their specific factors. If you learn this thing, we have done one question in module C in our marathon that is related to this. And advanced measurement approach, bank use internal system to measure operational risk, which is based on historical loss, probability of events, and effectiveness of control, internal control. But this approach requires approval from the RBI. To use this approach, first need the approval, right? Then what are the generic steps to measuring the operational risk? First, identify and quantify all the operational risk. Then focus on the most critical risk. Then create risk management strategies and audit plans, and estimate the risk level, which basically depends on three factors: probability of occurrence, this is the likelihood of the risk happening based on the historical data, right? Here it includes scale 1 to 5, where 1 is negligible and 5 is very high, right? Then next year, what are the impact of the internal controls? See, effectiveness of existing control just to reduce the risk, right? Then it expressed as a fraction of total control. So if we see the example of one thing here, the example of a probability of occurrence is given 2, and potential financial impact is given 4, which is very high. Effectiveness of control is given, internal control is given 50%. So how to calculate the estimate risk here? Estimated risk is equals to square root of probability multiply by impact multiply by 1 minus control effectiveness. So you can do the square root of 2 multiply 4 multiply 0.5, which is equals to 2. This helps bank in understanding how serious the operational risk and how much capital it should be hold to just manage this risk. Right? Then integrated risk management. It is the process of managing all types of risk together across the entire organization rather than dealing with separately. It banks the main risk include liquidity risk, interest rate risk, market risk, credit risk, operational risk. All risk together. Right? So why integrated risk is essential? Because managing the risk is essential for the survival and the success of financial institution. In this, we can understand and manage the risk centrally. In this, risks are identified, measured and managed using the consistent process across all the unit. What are the benefits of integrated risk management? It aligns the strategic goals with daily operation. It increases the transparency for the investors and regulators. It helps in growing revenue and earnings while controlling the losses, and also it reduces potential negative impact from the risk. So here, risk management should be a part of bank's overall strategy. Bank have to appoint a chief risk officer which is responsible for overseeing all the risk function. What is the role of this CRO? They manages the risk management department. They directly report to the CEO and MD. They ensures that the risk policies and procedures are followed. So the CRO should have clear responsibilities which should be approved by the board of directors, right? And this CRO should coordinate risk management across all the department. There should be separation of credit risk management from the credit sanctioning, which is important to avoid the conflict. So the process of identifying, assessing, controlling financial risk should be same across all the unit of bank. Bank need proper risk management system to provide data and analytical tools to support the decision making. And one more thing, we can say that integrated risk management is about seeing all the risk as a part of single system. It aligns the strategy, operation, policy and reporting. It also ensures risks are controlled effectively and the bank remains financially healthy while maximizing the opportunities. Right? Okay. So now, what are the things we need in integrated risk management? Proper organization structure should be there with board of director and the committees. Proper policies and procedures should be there, like what is the bank strategy, how to deal with all the risk together, and limit should be communicated across the organization. Use the common language of risk and standard risk measurement help maintain the overall risk within the acceptable limits. right? And top management should have holistic view of all the risk, and technology is basically support the integrated risk management, which helps system that can consolidate data from all department and provide a clear picture of total risk. So integrated risk measure management help the banks in meeting the regulatory requirement like Basel third. It allows the bank to reduce capital requirement if they use sophisticated internal risk measurement tools, right? So with this, this is okay. Now we have liquidity risk management. Liquidity risk is what? When bank is not having the enough cash available, right? That is liquidity risk. What is liquidity? When bank have the enough cash available to fulfill their requirements. So liquidity problem arises due to the mismatches in the timing of cash inflows and the cash outflows. So liabilities are the sources of fund, means cash is inflows, and assets, these are the application of funds, means cash are outflows. So in banking, maturing liabilities, they are considered as the outflows, and maturing assets, they are inflows. So mismatches are naturally in the banking. Banks are sometimes called banks are sometimes called maturity transforming agents, because deposits may be short time and withdraw can at any time. Loans like housing loan can last up to 10 to 20 years. So if a bank is giving 15-year home loan but deposits are only for 1 year, so obviously this will create the mismatch situation, right? Now we can say why the liquidity risk management is important, because liquidity risk is considered as the ICU for the banks. Even in a single bank can have wide ranging effects, because banks are key providers of liquidity in the financial system. Liquidity means enough cash to meet current needs, right? So here, liquidity risk is the risk that the bank cannot meet its obligations when they are due. So effective liquidity management involve raising funds by increasing liabilities and converting the assets into the cash quickly at the reasonable cost. That is the liquidity risk management is important. Clear? Okay. Now some of the key consideration in the liquidity risk management. That bank have to focus how many liquid assets are available. Are deposits stable or likely to withdraw suddenly? High dependence on short term borrowing, that increases the risk. Multiple sources reduce the dependency on any single source. Stability of the past deposit, reliability of loan repayment or investment, and trust from the depositors and the investors, and also the commitments like guarantee or letter of credit, and bank also backup plan in the case of sudden liquidity shortage. So these things should be keep in mind while doing the liquidity risk management, right? Now what are the practical issues in managing the liquidity? There are types of liquidity to maintain. So how many types of liquidity to maintain? operational liquidity, it needs daily cash needs, reserve liquidity, extra funds for short term emergencies, contingency liquidity, where funds for extreme situations. These are the types of liquidity which have to be maintained. And whatever how the changes are there in the interest rate, inflation or economic, that slow down affect the liquidity. And what are the access to the funds at the reasonable cost, like how much availability is there, how much cost of liquidity is there any early warning signs, and also ensures that planned solution can be executed successfully during the liquidity shortage. Right, these are the practical issues in maintaining the liquidity. So basically, a bank must be both solvent and liquid, right? So if in the case of solvent, in the case of solvent, see this thing, in the question is there from this one, total assets are greater than total liabilities. Liquid, where it is able to meet obligations on that time, and at any time a bank can be solvent and liquid, liquid but not solvent, solvent but not liquid, neither solvent nor liquid. So being solvent is not enough without liquidity. Even a strong bank can fail. Right? If we understand with the help of example, so let's see with the help of example. Here, if all the depositors demand their money at once, so the bank does not have enough cash, it can face it can face the crisis, right? And this also damages the bank reputation, that is called the reputational risk. Just a minute. Okay, so liquidity problems in one bank can spread to others, which cause systemic disruptions. And this 2008 subprime crisis in the US is the example where liquidity issue in some banks affected the global financial system. Right? So that is the liquidity risk example and the concept of the liquidity risk. So we can say that uh, liquidity risk management ensures that bank can meet its obligation without losses. It involves monitoring inflows and outflows, managing the mismatches between assets and liabilities, maintain the liquidity assets and contingency plans, using the early warning signs or the system to prevent the crisis. So a well managed liquidity system protects both the bank and the financial system from shocks and ensures trust from depositors and the regulators. Right? That is the liquidity management means. Now the thing is there, what thing is there now, uh, just a minute. Some principles we have to learn about the liquidity risk management. Okay. First, let's see the types of liquidity risk. Funding liquidity risk. This is the risk when bank will not have enough cash or fund to meet its obligation. Like if many customer withdraw the money at the same time, bank may not have enough cash to pay everyone immediately. Right? This is the situation when the bank will not have enough cash or the funds to meet its obligation. And what is market liquidity risk? This is the risk when bank cannot sell an asset at its fair price because the market is not active or there are not enough buyers available. So that we can say is the market liquidity risk. Right? Then we have here the concept of principle. Right? uh, Principles which are related to the sound liquidity risk management. There are the principles for the sound liquidity risk management. After the global financial crisis in 2008, BCBS introduced principle for the banks to manage the liquidity risk betterly. So here are the simple explanation. First, we have the responsibility of the bank. What are the responsibility of the bank? They should have enough cash and highly quality liquid asset to handle the normal operations and the emergencies. Supervisors can check bank to ensure they are doing this properly. Then clear liquidity risk tolerance. Banks should define how much liquidity risk are willing to take and considering their strategy and role in the financial system. Then we have here strong management oversight. Senior management should have strategies and policies to manage the liquidity. They have to regularly review liquidity positions and the reporting to the board. Right? And there is also incorporate liquidity in the decision making. Bank should consider whatever the liquidity cost, benefit and risk when pricing models or pricing products or approving the new business. In this, business lines do not take excessive liquidity risk. Right? Then we have here how to identify, how to measure and how to monitor the risk. That is important, to identify, measure and monitor and control. Active monitoring across the entities. Bank have to monitor liquidity across different business unit, currencies and legal entities. Bank have to use diversified funding strategy, and bank have to manage liquidity during the day to settle the payment and transaction smoothly. Bank have to manage collateral carefully, distinguishing between encumbered and encumbered assets. Right? Can you tell me what is the meaning of encumbered assets? Unencumbered. See, unencumbered means basically not having any burden or free of any type of debt or other financial liability, right? So basically, collateral management, where bank manage their collateral carefully, distinguishing between encumbered and encumbered assets. Then we have here the stress testing. What is the stress testing? Stress testing, we can say banks should regularly perform stress tests to see how liquidity would be affected in crisis, such as market wide shocks or institution specific event, and also the contingency funding plan, where banks should have a plan for emergencies that clearly define responsibilities and escalation procedure. So bank have to actively manage liquidity risk, monitors the cash flow, diversify the funding that maintains the liquidity risk, plan for the emergencies, and report transparently. Proper liquidity risk management prevents bank failure and protect the financial system, right? um, Yes, highly quality liquid assets are important. Public disclosure is also important, and liquidity risk management is basically banks always should have enough cash available, and RBI issued the guidelines to manage this risk under the ALM management system. First is 1999, later updated in 2007. So, successfully liquidity risk management starts from top management of the bank. Leaders must show strong commitment to integrate risk management into the daily operation and strategic decision making. Then again, in this we have the proper structure, same structure, board of directors who are responsible for everything. And then we have here risk management committee, elco, which includes the top management. Then we have ALM support group, right? And there are the risk management policies, strategies, in which they have to check the risk tolerance, they have to check the strategies, they have to check the prudential limits, measuring and monitoring, they have to check the stress testing, and also, which I already told you, they have to do reporting, all the things. And yes, this one is important. How to manage the liquidity risk? First, do the identification, then do the measurement with the help of stock approach. Looks at the liquidity at a single point in time. Looks for the liquidity at a single point in time. So, if a bank has 30% of its assets in cash or government securities, this looks safe, but it does not show if cash will run out next week, right? Then we have flow approach, which forecasts the liquidity needs over the time. It tracks the cash outflow and inflow for tomorrow, next week, or even for the next month. It helps in identifying the mismatches where cash outflows exceed the inflows. So effective liquidity management is very important. So bank can meet its obligation even during stress time by combining clear policies, risk tolerance, strategies, monitoring, and proactive planning. So basically, is that clear about the risk management, liquidity risk management? Mortgage, not mortgage. Uh, no, mortgage is not a thing here in the liquidity risk management. We can't say mortgage. In which regard you are saying mortgage? If you can tell, then I will help you. I think mortgage is related to the credit risk only, right? In liquidity there is no need of mortgage, I think. Like, according to me, mortgage is completely related to the credit risk. But in which regard you are saying, then I will tell you according to that regard. Then we have two ratios which introduced by Basel II, LCR and SFR. LCR and SFR we covered tomorrow. LCR, which is ensure short-term liquidity, and SFR to ensure long-term funding stability. So LCR, you know that LCR. What is LCR, right? Yeah. unencumbered. Yes, you are saying correct in that case. So basically, LCR is the ratio that have enough HQLA that can survive 30-day period, and it is basically highly quality liquid asset divided by total net cash outflows, and minimum standard for LCR is 100%. What are the HQLAs? You can see these are the assets that can be easily and quickly converted into cash with minimal loss. HQLAs are those, and in the HQLAs we can say this is there is low credit risk and market risk. These are very easy to value and sell. There is low correlation with risky asset. They are listed on recognized exchanges. Level 1 assets are cash, government securities. There is no haircut on level 1, level 2, level 2A, level 2B. These are less liquid, and 15% haircut is there. This is also less liquid, 50% haircut is there, right? And there are some risk monitoring tools. Contractual maturity mismatch, 5 tools to monitor the liquidity. Contractual maturity mismatch, which shows the gap between cash inflow and outflow. Concentration of funding, it check bank relies too much on few funding sources. Available unencumbered assets, it monitors asset that can be easily sold or used as collateral. LCR by significant currency, it ensures that liquidity is sufficient in each important currency. And also there is market related monitoring tool, where high frequency market data act as early warning signal for liquidity problems. Most of tools require monthly reporting, some are quarterly. Bank have to report these reports to the RBI just to ensure liquidity oversight. Then we have NSFR here. Let's discuss our NSFR. Then we are done with module B. Now we are left with module C. Okay, then we will take only 10 minutes break. Then we will continue with model C. And one more thing is there, I am forget to tell you, before NSFR there is FALCR, which is facilities to avail liquidity for LCR. Bank can assess additional liquidity through this FALCR only in the time of stress and after using all other HQLA. The facility can be used for a maximum of 90 days, and interest rate is 2% above the RBI, right? And NSFR, it focuses on medium to long term liquidity by ensuring that banks have stable funding structure. What is the full form of this? Oh, sorry, formula of this? This available stable funding divided by required stable funding, and this must be at least 100%. And if ratio above 100%, obviously that is having stable funding. NSFR guidelines proposed by the RBI in 2015, implemented in 2018. So this is in the module B. I hope that sorry, why I thank you. I think module C is clear. Sorry, B is clear. Now let's move to the module C. We will take 10-minute break. Let me give just a minute. let's take 10-minute break, then we will continue. Okay. Okay. I'm Then we will continue module C. So let's start with module C now. Treasury management, a very short and easy module. So approx in 1 hour we will complete this module C. So let's start here. Module C, treasury management. Okay. Treasury management. It is the process of managing a company or bank finances efficiently. It focused mainly on the funds management, but today it has evolved to include profit generation, risk management, and strategic financial planning. Right? So, what is the traditional role of treasury? In the past, treasury primarily handled the liquidity management, which means making sure the organization has always have the enough cash to meet its needs. That is the liquidity management. So in this, they are maintaining all the cash balances, right? They are deploying the surplus funds. They are managing the gaps between asset and liabilities, and also borrow or arrange the funds when cash flow is insufficient. And also they are meeting the reserve requirements like CRR and SLR. Earlier, treasury was mainly about liquidity management, but it was considered as a service center supporting the operations now. In the past, in the tradition, right? Now we have a modern role of treasury in the banks. What is the modern role according to the present era? Basically, after the economic reforms, in the 1990s, and deregulation of the financial markets, this treasury evolved into the profit center. Now it not only manages cash but also interacts with financial market to earn the profits and manage the risk. And what are the key modern roles that includes this? It connects the core business with the financial markets. Bank or companies use the treasury to assess the funds, to invest, or basically to borrow, right? And also use the trade in the financial market. Suppose a bank treasury team trades in government bonds or foreign currency to optimize the profit. Treasury also manages the risk which are arising from the fluctuations in the interest rate, currency notes, and security prices, right? So and also treasury do asset liability management. Treasury helps balance the company assets. And earlier, investment and forex were handled separately, but now treasury handles both together for better efficiency and for better profit, right? So this is the modern treasury. But now thing is there, what are the key characteristics of treasury? It focuses on short term. It deals mainly with the funds having maturity less than 1 year, except for long term investment for SLR purposes. Risk management, it covers short, medium, and long term risk related to assets and liabilities. Current account, it deals with trade transaction like import and export. Capital account, it deals with cross border investment and loans. And treasury ensures a smooth conversion of local currency into the foreign currency and vice versa. So integrated treasury combines money market, securities market and forex operations. So why integrated treasury is important? Because it allows the banks to operate across the market and currencies efficiently. It helps in mobilizing low cost fund and earning the higher returns. It provides a common approach to manage risk like interest rate risk, currency risk and price risk. So if the bank invests in the bonds in the India, it borrows in the US dollar and trades foreign currency to manage cash and earn profit while controlling the risk. This is the integrated treasury that combines the different markets. So what are the functions of the integrated treasury? Obviously they will do liquidity management, they generate the profit, they do the risk management, they do the asset liability planning, they also do the cross market operations. So we can say treasury also uses derivative products to protect against the risk of sudden changes in the interest rate. So treasury management is like the financial brain of a company or bank. It ensures that there is always enough cash, manages the risk, invests wisely, and even earns the profit by connecting operations with financial market. Right? Then large corporate clients always prefer dealing directly with the treasury instead of branches or other departments. Transactions between treasury and customers are called merchant business, which are different from treasury own trading and the investment. So corporate clients, they have own treasury department, they have expected the integrated services like they hedging the export receivable, they raise the foreign currency loan, they see the overseas investment, right? And one more important thing in this, that what some are the driving forces of the integrated treasury. It integrated the cash flow management, means it ensure that there is efficient management of inflows and outflows of cash across multiple currencies. There is also interest arbitrage, it taking advantages of differences in interest rate across the market. There is access to the global resources and also the corporate demand for high end services, and also they do the risk management, because corporate demands always good services like risk hedging and forex advisory, right? Okay, so this is the thing here. Now what are the functions of the integrated treasury? Meeting the reserve requirements, global cash management, merchant services which provide forex services, advisory support to corporate clients, and also optimizing the profit, because the main thing of treasury is now only the earning profit. Risk management and supports the ALM. Treasury ensures that surplus funds from operations are invested in high yield instruments while managing the exposure to currency fluctuations. Then initially treasury only a service center, only focused on cash flow. Different departments are there that handles merchant business, forex and investment separately. Integration created one treasury handling money market, forex and securities that provide the opportunities for profit. So why the treasury is profitable? Because there is a very low risk, right? And also uh, there is very high leverage. Treasury only operate with more borrowed funds than equity. There is very low operational cost because fewer staff manages large value transactions, and profit is earned on narrow margins, but very large transaction volumes are there, right? So we can say that this thing is different. Now treasury is different if we compared with the earlier treasury. Now treasury only focuses on like earning the profit. And there is also three completely distinct roles of this treasury. What are these three distinct roles? First one is the liquidity management. Liquidity management, still treasury manage the liquidity, like managing the short term funds across the currencies and ensuring compliance with reserve requirements. And also there is one word, proprietary positions. Proprietary positions like trading the currencies, securities, derivatives to earn profit for the banks. And third, risk management. Risk management, like bridging the asset liability mismatches, provides the derivative to the clients for the risk management, managing the risk, right? And also books are maintained in the treasury. ALM book, which is for internal risk management, merchant book, which is client related forex and derivative transaction, and there is trading book, that is basically proprietary positions and the market trading, right? So these are three books: ALM book, merchant book, and trading book. Now what are the sources of treasury profit? How the treasury earns the profit? First one is foreign exchange business, where they buy and sell the currencies for clients and interbank trading. Then spread, which is the difference between buy and sell rate. And treasury usually does not maintain large stock of foreign currency for the merchant business. It buy and sell from the interbank market. So any leftover currency at the end of the day is an open position that carries the currency risk. Money market deals, which basically lending the surplus funds and borrowing whenever needed. Profit comes from interest earned minus cost of funds. It is adjusted via transfer price mechanism. Branch deposit are treated as borrowed funds by the treasury, and interest paid or received is calculated to show the branch profit accurately. Then investment activity. Earlier banks invested mainly in government securities to meet the SLR requirement. So risk-free investment were not a major source of profit. And modern treasury invest in corporate debt, strategic assets to just earn the returns. Right? And what are the contemporary source of profit? Other sources are there. What are the contemporary sources? First one is interest arbitrage. What is it? Interest arbitrage. It exploiting the differences in the interest rates across the market and the currencies, right? Next, treasury products. Obviously it offers the structured products, derivative and hedging solution to the clients, and trading, active buying and selling of currencies, securities, and derivatives to earn the profit. So, treasury is no longer just a, you can say, just a service center. It is a profit center and also the risk manager. It handles cash, forex, investment, derivatives, while uh, assisting the management in ALM decisions. And profit comes from both traditional sources like forex and the money market, and also from the modern sources like trading, arbitrage, and treasury products, right? And corporate clients now treat treasury as a strategic partner and also expecting high end financial services, right? So then we can see here three main divisions of treasury: dealing room, front office, which handles all the market transactions. It is headed by chief dealer. Dealers are specialized in foreign exchange, money market, securities market, and as well as derivatives. They are the corporate dealers who handle major corporate clients. And asset liability management manages the bank asset liability risk. Securities trading is divided into primary market and secondary market. This primary market participate in the auctions of the government securities, and secondary market, here it trading in the existing securities. Then we have back office, which is the treasury administration, which is responsible for all the settlement, accounting, and verification. It maintains all the accounts. And third is mid office, which basically do the risk management. It all implements the policies, monitors the exposure limits, and it composed of experts. It is separate from daily treasury operations, right? So these are the three main divisions of the treasury. So treasury can be organized as the department of the bank. Treasury can be organized as the specialized branch. It can also act as the authorized dealer. And who is the head of the treasury? Senior management like general manager, chief treasury officer, or vice president. They report directly to the CFO, chief financial officer, or CEO, right? So what are the forward contract? Forward contract are those contract in which buying and selling of currency happens on the future date, but rates are decided today. It is generally used to lock the prices for today to avoid any future loss. So it is based on how forward rate is determined, based on interest rate differences between the two currencies, not the predictions. And it is added for low interest currency, and it forward discount subtracted for high interest currency. Forward premium added to the low interest currency, as we learn this thing in our chapter 1. And uh, forward contract is the concept. And then we have here uh, swaps. Swap, which is the combination of spot and forward transaction, or two forward transaction. It is essentially a exchange of cash flows, right? It basically manage currency needs for the funding, or also take the advantage of interest rate arbitrage. Then we have here one more thing: investment approvals. What is investment approvals? Treasury investment proposals are evaluated carefully. Minimum investment considered 5 crore rupees usually, and it is scrutinized by the investment committee before approval. So we can say that treasury organization is structured like this, that separate front office, middle office and risk management. Treasury also operate as a profit center, and also market participants are there and risk managers are also there, and corporate clients now seek the integrated services from the treasury for just hedging, for the loans and for the derivatives, right? Then money market. What is money market? Term, it is short term, and short term lending is there and short term borrowing is there. Money market is where banks and financial institution lend and borrow funds for the short period. It is highly liquid and it also plays a key role in managing the liquidity in the banking system. There are types of money market instruments. Call money, where in call money generally lending happens for a night only between the banks, whatever lending or the borrowing, and settlement happens on the next working day. It is used for meeting short term liquidity requirements. And benchmark is or overnight Mumbai interbank offer rate. Participants, banks, cooperative banks and primary dealers. If bank A need cash today, it can borrow from bank B and repay it to the next day at as per the agreed rate. Then notice money, which is basically lending and borrowing happens for 2 days to 14 days. It is used for slightly longer liquidity management than the call money. And here borrower gives a notice before repayment. Suppose if bank A need fund for 10 days, it can borrow from bank B and repay after the notice period. And what is term money? Where the lending and borrowing happens for 15 days to 1 year. But common duration in this 1 to 6 months, longer periods are less common. So it is just for managing the medium term liquidity requirement. If bank A invests surplus fund for 3 months with bank B to earn the interest. So these are the three different types of markets: call money, notice money and term money. Clear? Now we have here, after this there is one thing, there are some feature of the interbank money market. See, call and notice money rates reflects the liquidity in the banking system. Here it is considered very low risk since banks are lending each other and counterparty still exist here. And what is the benchmark used? On MIBOR, it is the used benchmark rate for the overnight rates, floating debt rates and also overnight interest rate swap. And how to uh, manage the liquidity, basically how to manage the liquidity and also the treasury. See, bank manages surplus cash after maintaining cash reserve ratio and statutory liquidity ratio. Currently cash reserve ratio is 3%, which is used by RBI to control liquidity in the system, right? And it is used by the RBI and no interest is paid by RBI on the CRR balance, whereas SLR is portion of net demand and time liabilities which are invested in approved government securities, right? Then we have the prudential limits for the bank and dealers. You can see for the scheduled commercial banks, lending maximum average in a fortnight 25% of capital funds, tier 1 and tier 2, and maximum 50% of capital funds. In the borrowing, maximum average in a fortnight is 100% of capital funds, and maximum on any particular day is 125 of capital funds, 125%. So this is a type of learning material. In the case of cooperative bank, borrowing limit is 2% of aggregate deposit at the end of March of previous year. Lending limit is nothing. And in the case of primary dealers, borrowing limit is 225% of net owned funds, and maximum daily average is 25% of net owned funds. And one thing is there, that is, what is the meaning of treasury bills? See, these are the short term government securities which is issued by Government of India through the RBI. Maturities are 91 days, 182 days, and as well as 364 days. Interest is earned through the discount, meaning the bills are sold below the face value and also redeemed at face value at the maturity. So suppose if the face value of a T bill is 100 rupees, and if a 91 treasury bill is sold at 99.26, so the investor is earning here 0.74 as interest. And what is the formula of yield? That is face value minus market price multiply 365 days divide to days to the maturity. Right? This is the formula of the yield. And what are the key features of the treasury? You can say it is issued through the auction. Banks and primary dealers are the main participants. Other financial institutions, corporate mutual funds, individuals, they can also participate. It is issued on fixed date or predetermined amount, like 91 day treasury bill is just generally weekly, 364 days a treasury bill is fortnightly. Risk free investments are also there, these are very liquid. And benchmark rates are T-bill yields, and these are held in SDL account and settled through the CCIL, right? And also there are the example for the bank treasury. You can see a bank has surplus fund of 50 million for 3 months, so they can invest in 91 day T-bill to earn risk free interest, which is usually higher than call money rates, right? Okay, so treasury and short term investment securities in the bank treasury. See, bank treasuries deal not only in the interbank market, but they are also dealing in the short term investment securities which are issued by the government, which are issued by the financial institution and companies, right? These instruments are used to parking the surplus funds for the short periods safely. So these are the some main instruments are here. Some main instruments, basically treasury bill, cash management bill, then we have commercial paper, certificate of deposit, repo, LAF, MSF, CBLO, here we will focus on the T bills and the cash management bills. So T bills I already told you. Cash management bill, these are also the government securities, short term government securities. Government of India issued them to meet the temporary cash flow mismatches. Maturity is less than 91 days, and uh, basically uh, the tenure and amount depend on the government cash requirement. It is issued at price lower than the face value. It is similar to the T bills, and it is made by the RBI through press release one day before the auction. T plus 1 basis, meaning payment and receipts are done one day after the auction. And bidding is not allowed here. And also, they can be used as repo, they can be used as MSF, and as a reverse repo facilities. Right? Then this is the cash management bill. Now commercial paper, it is also a short term debt instrument which is issued by corporate to raise the funds. Maturities are ranges from 7 to 1 year. It is also issued as unsecured promissory note at discount to face value. Who are the eligible issuer? Corporate, NBFCs, All India Financial Institution, limited liability partnership, trust, corporate societies, and government entities. So who can get this? Who have at least A3 rating from a recognized credit rating agency, right? And any bank or financial institution can issue this. LLP, trust or cooperative, they must have a minimum net worth of 100 crore, 5 lakh, and the multiples of 5 lakh is the minimum issue size. Bank can invest only in the commercial paper that are issued in the demat form. And also, banks can only issue this through an issuing and paying agent, which is a scheduled bank. And then it can be sold in negotiable, like it is a negotiable instrument, so it can be sold in secondary market before the maturity. And also CP is sold at discount, so return is the difference between the face value and the issue price. It is short term nature, which reduces the credit risk. An issuer can buy back the CP from secondary market after 30 days from the issuance at the prevailing market price. Right? So then we have a certificate of deposit. If I told you about the certificate of deposit, what is this? Certificate of deposits, this is the ideal money market instrument, or it is instrument for the fixed returns against short term and mid term investments. So it is a negotiable unsecured deposit instrument which is issued by banks or eligible financial institution. Maturity is from 7 days to 1 year, and 1 to 3 years for financial institution. Minimum amount 5 lakh for banks and 1 lakh for financial institution. It can be sold in secondary market, but market is less active than commercial certificate of deposit. Demat form, interest rate is usually higher. The bank can allow the loan against this, and bank can repurchase the commercial deposit after 7 days from the issuance, and repurchase commercial deposit must be extinguished. It is very safe investment. used for liquidity management. GSECs, government securities, one of the most uh, safer investment issued by government. Bank can invest 18% of DTL in approved securities. RBI can adjust up to maximum 40% and reduce it below 25%. So it is issued by the Public Debt Office of RBI, and also it can sold through auctions which are conducted by the RBI. And bonds pay the interest on the face value, but price may vary in the auction. It is also traded in secondary market, and yield fluctuates here with the demand here, with the demand of market. So you can see the example here. There is a 10-year GSEC, their face value is 100, coupon is 6.35%, current market price is 90.60, yield 7.72%, which is higher than the coupon because price is less than the face value. So here price and yield, they move inversely, right? If bond price falls, yield rises. If bond price rise, yield falls, right? So this is government security. Apart from this, there is one thing which is OMO. It is open market operation. These are the operations by the RBI to control the liquidity in the economy by buying and by selling the government securities in the market. It influences the interest rates and also manages the money supply, right? Here it infuses liquidity in the market. It helps banks to have more funds to lend, and if RBI sells the securities, it absorbs the liquidity from the market and also reduces excess money supply and controls the inflation, right? uh, then what are the types of government securities? There are the types: held till maturities. The purpose of these securities is just investment, recorded in banking book. Securities held until the maturity, not traded actively. Then we have AFS, available for sale. It is just for investment and trading. Accounting book is trading book. Securities can be sold if needed, and it is marked to market. Then HFT, it is also used for trading and speculation. Accounting book is trading book, and it is actively traded for profit. And here prices marked to market regularly, right? So here prices of securities move opposite to the yield. If interest rate rise, price fall. If interest rate fall, price rise. Then we have interest rate future. RBI introduced this trading interest rate future for 10-year government securities in 2009. Now future also followed the treasury bill durations, like 91 day for T-bill, 2-year, 5-year, 10-year for GSECs. And strip, it is a separate trade of registered interest and principal securities. Here principal and interest traded separately, and these are zero coupon securities. Then we have here the securities market products. Banks and treasury deal with various security products to invest the funds and to earn the return. First one is GSEC, which is risk free. Then we have corporate debt paper, which is medium and long term bond and debenture issues by the corporate and financial institution. Then we have debentures and bonds. Here, debt instruments issued by private and public sector companies. Then we have convertible bonds, that bonds can be converted into equity share after a certain period. And then we have equity, in which ownership shares are there in the companies, that carrying the ownership right and potential dividend, right? So then what is CRR and SLR? CRR is the portion of bank total deposit, 3% currently having the rate, and it must keep as cash with the RBI. The money can't be used for lending and for investment. It is the tool by RBI to control the liquidity in the economy. What is SLR? It is basically 18% currently of NDTL. It is the portion of the again bank total deposit that is invested in approved government securities or approved bonds. And unlike the CRR, the money remains with the bank and cannot used for lending. SLR ensures that bank maintain a cushion of safe investments and also provides funds for funds to the government. But why these SLR and CRR are important? Because they control the money supply. They ensures the bank liquidity. They protect the economy. And there is most important money multiplier effect. Not all money is there in the circulation. Bank lend deposits, credit more deposits, increase money supply. So CRR and SLR reduce this money multiplier effect. Example, suppose the cash is there with the public is 100 crore, which is M1. Total money supply, which includes deposits, M3 is 400 crore. So what is money multiplier? Money multiplier is M3 divided by M1, which is 4 only. So increase the CRR, that reduce this M3 and lowering this multiplier effect. Clear? Now we can say that in last regarding to this, that in easy words, that the CRR cash balance cash banks keep with the RBI. SLR safe investment banks keep in the government securities. Treasury ensures that these rules are met and manages the liquidity. RBI uses the CRR and SLR to control the money supply, inflation and financial stability. Okay. how treasury performs any role in managing CRR and SLR? Obviously, because treasury is responsible for the liquidity management, so it meets the CRR and SLR requirement. It monitors the liquidity, it reports to the RBI through the form A to the RBI. It manages the funds efficiently. If suppose CRR increases to 3 to 4%, treasury needs to take this extra money with RBI, reduce the funds available for loans, and if SLR rises, then treasury has to buy more corporate bonds, government bonds, temporarily reducing lending capacity. Right? Then we have the bankers acceptance facility. What is it? Any negotiable instrument like a post dated check guaranteed by bank, these are used for large transaction. Whereas bill rediscounting, when a short term debt instrument is discounted again by another bank or financial institution, that is called the bill rediscounting, right? So BAF is a banker acceptance facility. Suppose if a company A sell goods to company B and gets a bill, company B bank guarantees it under the BAF. Company A can sell it to the another bank at rediscount for cash before the maturity. Right? So this is basically the BAF. Then we have here, so you can see if CRR SLR increase, there is very less money available for funding, for lending, sorry. If decrease, so more money available for lending. So RBI as the lender of last resort, if a bank faces short term liquidity problem, RBI can provide cash support. This is very rare, only for the banks that are solvent but temporarily short of cash. If a bank has enough deposit and asset but sudden large withdrawal occurs, so treasury cannot meet immediately CRR, RBI can lend funds to cover this gap. Right? Little bit left. Then here we have one thing, that is uh, DTL, which is this is demand and time liabilities. So what is it? Demand and time liabilities, we can say that these are the funds that customers can withdraw anytime, and time liabilities are fixed term deposit with the maturity dates, right? So in other words, you can say this is the total deposit and liabilities of a bank, which is used to calculate CRR and SLR. Demand deposits are the current account, saving account, margin money for letter of credit, overdue, the fixed deposit. Whereas time deposit, they are fixed deposit, recurring deposit, and reinvestment deposit. In this, we can include overseas borrowing, foreign outward remittance in transit, and other demand and time liabilities. Right? This is the DTL. And what are the things that are excluded from CRR and SLR? Paid up capital, reserve, retained profit, any refinance from RBI and Apex institution, income tax provisions, claims from insurance or court, banker acceptance facility, rediscounted bills, and also any subsidy fund in the specific account. Right? So these are the excluded from this, our CRR and SLR. Then we have one thing, which is payment and settlement systems. RTGS, you know about the RTGS 24 into 7, above 2 lakh we can use this, and NEFT also secure and payment done in batches below than 2 lakh. We have Infinet. Infinet. Infinet is basically very secure communication network like Swift, but is it supports the structured financial messaging system for domestic fund transfer. Then we have NDS, that is negotiated dealing system. It is a electronic platform for government securities and money market instrument. Then we have NDS OM, which is order matching. It is allowing the anonymous trading, and there are some depository institutions like NSDL and CDSL, which provide delivery versus payment for equity and debt instrument. But what is the full form of this NSDL? This is basically National Securities Depository Limited, National Securities Depository Limited, and CDSL is Central Depository Services Limited, right? So LAF, RBI manages this short term liquidity in the banking system. Bank can borrow from RBI by selling the securities with an agreement that they will repurchase, and interest is the difference here. Bank lend to the RBI by buying the securities and earning the interest. There are variable repo rate, 7 days, 14 days and 28 days. Then money market instrument I already told you. And yes, so these CRR and SLR, these are the tools to control liquidity and money supply. If there increase in the CRR or SLR, that means liquidity absorption is there required, and it reduces the money supply, which will controls the inflation. And if is there decrease in the CRR or SLR, that means liquidity release, that increase the money supply, that boost the credit and investment. So are you getting it, whatever I am speaking? Like, it is important to understand the things. I hope that everything is understandable. Okay. Treasury risk management. Treasury risk management, same process everywhere. Risk management, we have to include identification, monitoring, controlling, mitigating. So treasury handles the activities such as foreign exchange, trading, money market operation and investment in securities. These activities carry the risk because profits are generated from market movements and losses can occur if market move unfavorably, right? And what are the types of treasury risk? Market risk, credit risk, as we already learned this in the uh, previous chapter. And why the treasury risk management is important? Because if we don't manage this, there is very high risk of market risk, and also treasury can trade large sum of money with minimal direct capital. There is large discretion, like transactions are often large, ranging from 5 crore to 50 crore. Treasuries operated with the delegated authority, and they need rarely management approval. Treasury losses can happen very quickly, and market reactions are almost instant, especially in the foreign exchange. And then we have here limits. Limits are there on the trading positions. See, what are the limits are there on deal size? This is the maximum value of that single transaction. Limits on open positions, maximum exposure from unmatched buy and sell positions, and there is also the stop loss limit, which prevents the loss from escalating if the market moves against the market. And there are also the types of open position limits, in which we have daylight limits. It is intraday exposure, means some buy in the morning and sell in the afternoon. And what is overnight limits? Obviously overnight means which is held for overnight, because this risk is higher when positions are unmonitored. So here we can say in last that treasury risk is higher than the credit risk due to leverage and speed of transaction. Main types of treasury risk are market risk, credit risk, settlement risk. How to prevent? By do the organization control, by do the exposure limit, by position and stop loss limit. It monitors and supervisions are crucial to avoid any type of significant losses. Treasury risk management is completely linked with asset liability management. So this is the this we can say. Now let's move to the principles of the treasury risk management. We know that front office, mid office and back office are there. Position limits, maximum amount that dealer can trade or hold, and stop loss limit, maximum loss which is allowed on a deal or per day, month or year, right? Exposure ceiling limits, these basically those limits that help the bank from the concentration, prevents the bank from the concentration risk, because treasury is not allowed to lend all surplus to a single bank. Concentration risk is that now where all the lending happens to only one borrower, only one sector. It helps reduces the credit risk in interbank lending and repo transactions. Then derivatives. What are derivatives? A financial product whose value depends on underlying asset such as currency, bond, commodities or stock indices. So value of a derivative is derived from the value of the underlying asset, right? So it is mostly concerned with future prices. Then in the purpose is basically to do the risk management, to fulfill the client needs, to do the trading. Then we have forward contracts. I think forward contracts, you know that what is forward contracts, but included in this chapter, it is an agreement to buy and sell the currency at a future date or at fixed price. ठीक है, right? So it is an OTC product and it is mostly used by exporters and importers. So they can get hedge, they can get protection from exchange rate risk, right? Okay. Now there are two types of derivative product: over the counter because they are customized, and exchange traded product, they are standardized contract. Option, where the it gives the buyer a right but no obligation. In call option we have right to buy. In the put option we have right to sell, right? So what is the strike price at which the underlying asset can be sold or bought? Expiry date, date when options can be exercised. Option holder is the buyer and option writer is the seller, who are Americans and European. Options, Americans are not allowed in India, but it can be exercised anytime before expiry. But European, they can be exercised only on expiry date. And in regard the option, I can add this. What is the meaning of option premium? Whatever the price paid to buy the option upfront. We have here the intrinsic value that used in the, I think we have done some formulas on this. Intrinsic value, that is the difference between the strike price and current forward rate, right? It is basically premium minus intrinsic value. So option sellers always have unlimited risk, but option buyers have limited risk. Then what are futures? Yeah, these things is important. At the money, where strike price is equals to the forward rate. In the money, where strike price is better than the spot or forward. Out the money, where strike price is worse than the spot or forward. Then what is the meaning of future? Futures are the standardized forwards contract that are traded on exchanges. Buyer and seller, they execute the contract at agreed price on delivery date. Here no, it's important. And what is interest rate swap? Interest rate swap is exchange of cash flow, while interest rate swap, exchange interest payment on a notional amount. Fixed, say floating, floating to fixed, floating to floating, that depends on interest rate swap. Then currency swap, where exchange the cash flows in the different currencies. And their asset liability management. Yes, one more thing, forward rate agreement. Forward rate agreement, you can say like forward rate agreements are the agreement that fix interest rate for a future period, right? And then we have ALM, asset liability management. I think it is a process by which a bank manages the risk due to mismatches, right? And bank collect deposit from customers with the different maturities, and it is ranging from few days to several years. These funds are used to provide loans and investment with various maturities. Bank can take risk on the credit risk, and market risk is there. Asset liability management, you are aware now because complete D module is based on this. Basically, what is the role of treasury in the asset liability management? It manages the fund, liquidity, and interest rate risk, and it links the core banking operations to market operations, and also treasury monitors the market risk and hedge the ALM manage like hedging the ALM here. And also treasury products are tradable that provide liquidity in the times of need, right? So we can say that here, according to the RBI, short term liquidity is monitored in the time buckets like next day, 2 to 7 day, 8 to 14 days, and 15 to 28 day. Negative mismatches should not exceed prescribed limit. This next day 5%, 2 to 7 day 10%, 8 to 14 days 15%, 15 to 28 days 20%. So what are the contingency measure? Stand by the credit line from other bank, hold the liquid securities above the minimum requirement, and using the RBI facilities like LAF. What is interest rate risk? When the bank interest income from the assets is not enough to cover interest expenses on liabilities due to changes in the market interest rate. This risk affects the NII. NII is the difference between interest earned on assets and interest paid on liabilities in a period. And what is interest rate mismatch? It occurs when asset and liabilities are due to repricing at different times, right? So yeah, most important, ALM in the Indian scenario. You can see here, just a second. Okay. So depositor preference is here. Indian depositor prefer here fixed rate deposit, and banks like SBI and IDBI tried these floating rate deposit in the past, but depositor did not like them, so these schemes were withdrawn. Now interest rate risk passed to the banks. If market interest rate rise after the deposit is made, so depositors often ask for premature renewal. And yes, MCLR. On April 1st 2016, RBI introduced this MCLR system. Loans are now mostly at the floating rates. If interest rate fall, bank net interest income decreases. If interest rate rise, bank may not fully benefit as many depositors renew at the higher interest here, that neutralizing the advantages, right? So how to use the derivatives in the ALM? Derivatives are just to manage used to manage the liquidity and interest rate risk, and bank here convert the fixed rate loan into the floating rate just to match the cost of deposit. So derivatives are cost effective and they do not require large capital deployment, and basically Indian depositors prefer the fixed rate deposit, which passing interest rate risk to the banks, and treasury also plays a critical role in managing liquidity and interest rate risk. Derivatives are used to hedge the ALM risk. Treasury product like commercial paper bond that help in reducing the mismatches. Credit risk in treasury arises mainly from counterparty risk, and also RBI regulates the CDS and securitization to maintain the market stability. So floating rate products are there, loan and deposit which are linked to the benchmark, they reduce the mismatch risk. Bonds with the embedded option that will improve the liquidity. So hedging completely depends on benchmark linked pricing, and market risk may not be completely eliminated because it is impossible. And then here treasury deals with market risk. Credit risk is treasury is limited to the counterparty exposure, and here we can say that corporate bonds and commercial paper both are different, and bank invest in bonds instead of giving the loan because bonds are tradable, and bank convert the loans into the tradable bonds or pass through certificates, right? And credit derivatives, instruments to transfer the credit risk to another party for a fee, in which we have CDS and CLNs. CDS, that protection buyer pays a premium to protection seller. In CDS, similar to the CDS but structured as tradable note. Then CDS work, here protection buyer own a corporate loan, and here it sell risk to the protection seller who guarantees payment in case of default. So basically RBI allows single name CDS on corporate bonds. Basically what is this CDS? If I give you the overview, a short example of definition of CDS, this is certificate of deposit, right? CDS, you already know that the certificate of deposit is CD. CDS is credit default swap, which is a financial derivative that act as a insurance policy on a loan or a bond, right? So who are the eligible entities? Bank, primary dealers, NBFC, mutual fund, insurance companies, housing finance companies, provident fund, and the listed corporate. So CDS can be used to hedge the banking book and trading book exposures, right? So this is about the module C. Module B, A, D completed. I hope that it will help you. Now just release all of your tension. All the very best for your examination. Do your best. Revise the PDF. Once I will sharing in a while the numerical PDF also, that will also help you. And now relax, everything is going good tomorrow. So all the very best. Kindly uh, do tell me the how was the paper and result and everything. So thank you so much. Go and sleep now. So I hope that the class is useful for you, these notes are useful for you, that is the only thing. So thank you so much. Let's meet tomorrow with our smiling faces. So all the very best to all of you. If you have any type of problem, you can ask. So let's meet tomorrow. Have a happy night and all the best for tomorrow. Give your best. You're already all are the rock star. So thank you so much. Let's meet tomorrow.